First, if any of you have been trying to get onto the website, then it's down for some domain transfer should be up by Wednesday. So if you're on the mailing list, you'll probably be up to date with all the mails coming in. So that should not be a problem. Coming to the markets, for every stock that's appearing to be headed up, there are 3 to 4 that are headed down. I think that's becoming more and more apparent every day. The index itself is still not catching up. There are some early signs. The small cap index broke again the low that it made on Friday today. So clearly that's continuing to be the lead indicator of the downside. The mid cap index being somewhere in between, the press negative again today by the second half, with some 1500 stocks almost on the downside. So clearly it looks to me still as a distribution pattern that is still incomplete, and it should be done, you know, I don't know by when, because time is really the toughest part in the science. All of January I was looking for the ending diagonal to complete, and January is ended on Friday. It looked like we broke down from that pattern, so at least something started on the downside. But are we an impulse down, or are we still going to make some more gyrations within a trading range before breaking down, is something that's a little harder to predict, but I would always try to expect the breakdown first, especially given the lead that the other indices are doing on the downside. We also have a negative monthly close on the mid cap, small cap indices. I should probably have the long short report out later once the sites up. And you have many stocks that, or even the index closing down for the week. So all of those are indications that you've completed the so-called 5-wave advance from the July lows, and that should mean a correction to the 5-wave advance. And my larger wave structure, if right, then it should also mean the starting of a even larger downward trend that could last for most of 2013. So one of those two things, at least, if there's any completion of trend and a reversal, we look for that. But I think the sense is looking at still the longer term chart one, which I sent out a couple of days ago, showing the Nifty along with the mid cap and small cap from 2008 to date. It shows that those indices have been underperforming by a large length, and that should instantly mean that all long-only investments in any diversified portfolio, unless in very specific stocks, would have underperformed or done badly during this time period. Then that's, I think, the experience of most investors. Have been traveling most of this month through 4 cities on sales trips, and I think all the investors I've met have had that experience with their long-only investments. So it was a very clear pattern. And if you plotted the same thing from 92 to 96 to 2000, and you looked at the BSE 200, which was the mid-cap index, then you would see the very similar pattern where the 200 would have underperformed big time up to 1998. The only time it really took off and made a higher high was during the tech bubble. So what I've been writing about in most of my long short reports is the index targets ranging closer to 1500 plus or minus, unless you're developing a bubble, which would then push you back all the way to 6700 or something. And so till now, even after all the measures that have been taken in terms of reforms and rates, the stock market itself is still not showing signs that we are building up into a bubble rally. And I think that's where my concern comes from. Till I can see that clearly, my sense is that a 5-wave advance completing is an indication that you need to be really careful and prepare for the downside risk that's coming ahead, rather than look for the upside. And the weak performance of the broad market and of portfolios is a clear indication of things not improving at the ground level. So taking that hint, I think the other risks are also slowly coming into place. The ones that are from the currency side, we are watching the dollar index close to the 79 mark. Even though the euro is making new highs, I showed in my video some time back that several other currencies have started weakening against the dollar, and that trend isn't abating. If you just look at the British pound or the Singapore dollar or the Australian dollar, they are actually beginning to weaken. The franc did, advance again, but that may be somewhere in between. I mean, it may be still in the last stages of turning around. So many other currencies which are at some kind of retracement and could at a point turn around with the dollar. So we'll watch that. And the second one, of course, I've been talking about bond yields moving up on the US. They are at a breakdown point. The treasury prices did fall below the low that they made last week, but we didn't get a very sharp dip. And somewhere when that happens, I think it will cause people to start getting scared of interest rates in the US. So that's another risk that we will be dealing with in the weeks ahead from the global market side. So given all of that, and our market seems to be leading ahead, it's not really rallying with the rest of the world markets, which is again another sign of how our market is not really behaving the way you would want it to if we were in the midst of a bull market. So if that's warning enough, I think we just need to be prepared for the downside risks. On long only investments, I think you really need to be hedged or out and looking for short side opportunities in the market for the months ahead. That's all in this update. Thanks and bye.